Hi, this is Scott Staratt with Staratt Wealth Management at Canaccord Genuity Wealth Management. Today, I'm very fortunate to have Jason Mann, who's the co-founder, partner, and chief investment officer of EHP Funds. Jason was the managing director and co-head of Absolute Return and Arbitrage Group at Scotia Capital, and spent a significant amount of time running their merger arbitrage desk, event-driven desk, quantitative proprietary trading strategies, and had oversight as far as trading and a proprietary trading book. He was the head of agency at Scotia overseeing 18 professionals, and holds a bachelor's degree in business administration from Wilfrid Laurier University and a CFA charter holder. In other words, he's a bright guy who has a lot of experience. So this is why I'm very happy to be able to talk to Jason today. Hi, Jason.
How are you? It's a pleasure to be here, and thanks for having me on.
Yeah. So let's get right into it. I mean, you know, we're all from different backgrounds, and obviously I went through a little bit more of your background at Scotia and assorted kind of roles there. But whatever made you interested in managing money? And part two to that is, how did EHP all come together?
Right. So it's interesting. I started at Scotia originally on the distressed debt desk. So trading. This was back in 2002. It was the midst of a recession, and we were trading bonds of energy companies like Enron that had gone bankrupt, and El Paso and Calpine and some of these U.S. energy companies. So we started in a proprietary trading group. And proprietary trading just means you're trading with the bank's money. So it means you have a single client, the bank. So raising money is not the problem. But obviously, if you lose money, that is a huge problem. And if you want to survive on a prop desk, the general rule is don't lose money. So that was very interesting to me. You get to understand how businesses work, invest in them, and ultimately profit if your strategies or analysis is correct. And that really, from there, we moved up to the Scotia trading desk, where we executed a number of strategies for the bank. We covered hedge funds as clients, so we would actually recommend trades to hedge funds, and we would put those trades on ourselves. We traded, as you said, merger arbitrage, which is profiting from companies that are involved in a merger or an acquisition. We did quantitative long short, which is very similar to what we do at EHP, where we're buying and selling stocks based on particular attributes. So a fairly broad range of investment styles. And that was really the benefit of having worked at Scotia on that desk. That really led to us wanting to go out on our own to pursue very much the same strategies. We didn't really change the way we ran money, but we were now able to do it on our own. And that meant starting a firm, EHP, where we actually raised money from outside clients like yourselves, advisors who are allocating dollars on behalf of their clients. But the running money part actually didn't change all that much. So EdShow came together, EHP came together. It was really a partner of mine that worked with me on the Scotia desk, Ian Fairbrother. We had a third partner who had access to capital, and we had an anchor tenant, an early private investor, actually from the Calgary area, who seeded the fund initially. And that really gave us the confidence that we could have a baseline starting point for the firm. From there, in 2013, we launched our EHP Advantage Fund, which really is our flagship fund. And then in 2018, we launched a number of what are called liquid alternatives. So these are probably the next generation of hedge funds where you can get access to for retail investors in a much easier to buy fund format, a prospectus offering, just like a regular mutual fund. So that's really kind of how the firm has evolved from the start.
Great, thank you. So, you guys have a very disciplined process in how you manage money. As you've said, it's disciplined enough to avoid getting fired from Scotia, meaning you didn't lose any money. So it must be disciplined. So can you kind of walk us through, what that is, just in a nutshell?
Sure. So we'd be we'd be called a quantitative investment manager. And quantitative, is a complicated way of saying that we have a disciplined, rules-based, systematic process for managing risk. And what that means is we don't use an emotional or a discretionary process when we're picking stocks or managing our risk exposure. We have a set of rules that are time-tested in the sense that we're looking at history and how markets have acted during periods of stress, and we're building models or a set of rules that will cause us to act in a certain way consistently. One of the things we learned on the desk at Scotia, you never want to manage risk while risk is occurring. In other words, you don't want to have to be making decisions about your portfolio in the midst of a meltdown like we saw in March of 2020. That's exactly when you're likely to make the wrong types of decisions and make decisions that are based on panic and fear and not on some type of process. So at its core, we are long short stock investors. That means we buy and sell individual stocks. We buy them long so we can profit if it goes up, and we'll short stocks so we can profit if the stock goes down. The way we do that is a little bit different than a traditional manager. We don't talk to management teams. We don't care about the story of a stock. What we really care about is its attributes. So show us the data, and that helps us make our decisions. The things we look for specifically when we purchase stocks, we want a stock that is cheap. So it's relatively cheap on price to free cash flow or return on equity or traditional valuation metrics. We want a stock that is in an uptrend, and meaning that the share price is moving higher, not lower. And we want a stock that is relatively stable. In other words, the share price isn't bouncing around a lot. Those attributes historically have led to outperformance. If you bought stocks that were cheap, rising, and stable, you do better than if you just buy the average stock. On the flip side, for our shorts, we want stocks that have the opposite of that. So we want expensive stocks that are in a downtrend that tend to be volatile. And again, historically speaking, those types of stocks have done poorly over time. So if you can build a portfolio, long and short, that's long, cheap, rising, and stable, and short the opposite, you can tend to do better than an index. And you can certainly be less risky than an index. And that really is our objective. The other key thing that we do across our funds is all of our funds have a process for decreasing risk as markets become unstable. So that, if we look at the recent period of volatility in March of 2020, our funds would have decreased risk in February, came into March with very little risk, and most of our funds were either flat or even up in the month of March, which was a month where indices were down 20 to 30%. So it's that risk control, that pre-programmed process that helps us through periods like that.
Okay, great. So we're in a period now of some pretty low interest rates. I mean, we have been for a while, and it looks like the central bankers of the world are saying that that's going to continue for quite some time. How does that affect the way that you look at either your models and your strategy, or just in general to what you see the environment out there?
Yeah, so low rates are a challenge for all investment strategies. Low rates have the effect of compressing investment returns. The most obvious way they compress returns is in something like a bond, right? If you're buying a bond when rates are at, let's say the bond yields 1%, similar to the US 10-year, it's actually below that now. If you buy a bond that yields 1% and hold it until you get paid back, your return is exactly 1% per year, plus or minus the fluctuations in between of the bond. So rates have a direct impact on the return of something like a bond instrument. But that same effect flows through to all other investment strategies. Merger arb is another strategy that has a bond-like characteristic. It's impacted by low rates. But even pure equity strategies where you're buying stocks, you might not think that low rates affect that, but ultimately everything is priced off of the prevailing interest rate in one form or another. The risk or the return that you expect to get from holding a stock is still directly attributable back to the baseline interest rate. So what it does, low rates also tend to happen during periods of low growth and low inflation. And that's certainly been the environment lately. And it's probably the environment looking forward over the next couple of years. So if you've got low inflation and low growth, there are certain equity styles that tend to do better. Value, as an example, is a style that does best when the economy is growing rapidly and there's a risk of inflation. And it's because value stocks tend to be more cyclical. Think about manufacturing businesses, consumer discretionary, financial companies. They're all in that value bucket, and they tend to do better when the economy is growing. The types of companies that do better in a market with low rates tend to be growth stocks. And it's a bit contradictory. Why are growth stocks like technology, why do they do better in an environment of low rates? Well, because they're the only ones that have any growth. So when growth is very scarce, people overpay for growth stocks. And that's been the problem in the last couple of years. People are arguably overpaying for the Microsofts and the Apples and the Teslas of the world because they can show growth. The problem is that tends to create these big divergences. So growth outperforms for so long, it becomes very, very expensive, and it actually makes it a very dangerous situation. So how do we manage that? We try to be balanced. Value hasn't worked very well for the last couple of years. It may still be a tough couple of years for value, but historically, the attributes tend to balance out over time. So we want to be balanced between stocks that are growing, like the technology stocks, and stocks that are more cyclical value oriented, like financials, like industrials. For us, it's all about trying not to get crowded, trying to mitigate the risks, and understanding how these cycles play out, very much driven by the interest rate cycle.
Okay, interesting. So, just going back to kind of the hedge fund industry, we would term, a fund like yours as an authentic hedge fund, as opposed to a performance hedge fund where, you're really trying to protect client assets and things like that, as opposed to, borrowing a whole bunch of money and going out and rolling the dice. When you look at the liquid alternatives, and you mentioned, that's one area that EHP has spent a lot of time in. And as a matter of fact, I think you hold the record for the most successful launch of liquid alt strategies in Canada to date. So congratulations on that. But, to the average investor, this liquid alt area is still a relatively new and potentially dangerous area. Being kind of in the trenches day after day and competing against these other managers, some of which are banks, some of which are independent like yours, how do you see the landscape right now in the liquid alt side?
Yeah, so it's funny. I mean, the term hedge fund has a negative connotation, and that's partly because the media tends to write the stories that are the most interesting. So it's the hedge funds that have blown up and lost their clients' money, or it's the hedge funds that have had astronomical returns from some big bet, big trade. Ironically, so it makes them sound a lot riskier than they really are. As you noted, authentic hedge funds are really designed to reduce risk, not increase risk. We want returns that are less risky than the market, certainly a lot less downside risk. So we still want to earn an economic return, but we don't ever want to lose a meaningful amount of money. And that's a key element of a real hedge fund. So liquid alts is really just a term that describes a new packaging for what has been traditional hedge funds. And the liquid refers to the fact that our funds can be bought and sold on a daily basis, but really we're still doing the same things we used to do before we could sell in this new market. We're using a moderate amount of leverage, and we're using shorting. Those are two things that sound risky, but can actually be used properly to reduce the risk of a fund. And if you look at the returns of our funds over time, you'll see that their sensitivity to market moves is a lot less than the market. They protect a portfolio in downturns, and they have moderate participation in upturns. So they give you a smoother ride, but ultimately you'll get to the same place. Liquid alts, I think the room for them to grow in Canada now is in replacing what used to be the bond portion of a 60-40 portfolio. So a traditional balanced portfolio would have a portion allocated to stocks and a portion allocated to bonds. Bonds tended to go up when stocks went down, everyone was happy. The problem you face now is in a world of effectively zero interest rates, the bond portion of that portfolio probably isn't going to offer you much protection anymore. In fact, it may even become correlated with equities, meaning they'll go down at the same time as equities. That's a real problem. So investors are looking for an alternative to this problem, this bond problem, and alternative funds, liquid alts fit that really well. We can generate returns that look similar to what bonds used to be able to do, but without that correlation to a bond portfolio and not necessarily correlated to stocks either. So they have a place in a portfolio. I think if you look at who has launched liquid alt funds, it kind of goes into two buckets. Managers like ourselves that have been traditional hedge fund managers for 7, 8, 9, 10 years. We've taken our strategies and put them into this new wrapper, if you will, this ability to sell it as a mutual fund. And then you've got some more traditional long-only mutual fund managers who like the idea of being able to have longs and shorts, but don't have a lot of experience doing it. Those are the ones we're a little bit wary of because we've earned our battle scars along the way. Shorting is not the same as being long. And managing leverage and shorting risk is a unique skill set. Not that those managers can't learn it, but you don't really want them to learn it on the job with your dime. And so for us, there's a handful of very good managers out there that have been doing this for a long time in the private hedge fund world that have launched a liquid alternative product, and now that's available to the average investor.
Okay, good. You mentioned before, and you have a very data-driven type of strategy. The media, whether it's COVID-19 statistics or Donald Trump statistics or whatever, really likes to hammer the idea of data and the manipulation of data in out there. How do you find the data you're able to determine from the stocks that you're buying or selling? Can you trust it?
Good question. So there's lots of alternative data sources out there now. It's kind of become the flavor of the day is trying to find some brand new data source that no one else has access to, and that's your source of return. We take a different approach. We are very simple. When we're looking at, if I go back through the three factors we talked about, price momentum or trend, that's just a measurement of what the price does on a day-to-day basis. So that data is what it is. There's no way to manipulate it. It's available from multiple sources. And the reality is that stocks in motion that are trending up tend to stay in motion for a period of time. The same thing's true for volatility or volatile stocks. A stock that bounces around a lot, again, that's just a measurement of a price effect. There's no way to manipulate that data. Where you can find more challenges is when you're trying to evaluate fundamental data. So now we're looking at the actual reported earnings of a company, their balance sheet, their book value, their return on equity. There are lots and lots of ways that companies try to manipulate that data to position themselves in a more favorable light. And you'll hear terms like adjusted EBITDA, and it's this complicated methodology for stripping out all the bad things that a company doesn't really want to tell you about and trying to get you to focus on, oh, here are earnings if you ignore all these bad things. So that's the trickier part of our job. We pull data from a couple of different sources, including Standard & Poor's, Bloomberg, and a number of others. So we actually average a number of data sources together because there's always a little bit of opinion in those hard data numbers. So the more opinions we can get, the more of the average we get, and the cleaner our data is. But there's no question, there is a process of data cleaning, data sourcing, and trying to get a clean version of what a company's real underlying data is. But for the most part, we like to keep it simple. We keep to the basics. Show me their cash flow, show me their balance sheet, show me their debt, show me the quality of their earnings. Combine that with price signals like trend and volatility. That's all the information we need to be able to make a decision on a company.
Okay. Last question I had was, you EHP has spent a lot of time and effort on risk management, and you've talked about that today and how particular you are around that. But, being responsible for, hardworking people's money, it can be very stressful, obviously. And especially if you think about, how many thousands of people rely on you to manage, their retirement or manage their savings. Not to put any more stress on you that you don't already know, but, how do you handle that within the confines of EHP or personally?
Sure. Well, look, we don't take that obligation lightly. We are not only are we managing the retirements effectively of thousands of clients. We know a lot of these people, right? Some of these clients are personal friends, they're family members. The majority of our personal wealth are in our funds, and I think that's an important consideration to know that we're invested alongside our investors. So, we really care about the returns and we really care about the risk. You're right. It is stressful to manage that, but it helps for us to have a process, a systematic process, where we know in advance how we're going to act during times of stress. You'll hear a lot of people talk about buy and hold is the best way to retire. Just buy it and forget it. That makes a lot of sense to me when you're young, right? And you have the time to recover from what might be a bad market period. But it makes a lot less sense as you get into those retirement years. Let's go back to March of 2020. The Fed, the US federal government, stepped in to prop that market back up, and thank goodness they did. But what would have happened if it was more like the 1930s and we spent the next 5 or 6 years in this perpetual market decline? If you were someone who was counting on that money to retire, you can't recover from that. You can't recover from a 30, 40, 50, 80% drawdown like we saw in the 1930s. So the buy and hold mentality, only works if the market does rebound and quickly enough that you can get back to your capital base to retire. The other thing that buy and hold ignores is people tend to make bad decisions at exactly the worst moments. It's fear and greed, and people are inclined to panic at the bottom. So you might have a temporary market drop that you turn into a permanent loss because you panic at the low. Our alternative, and again, it helps with managing the stress of managing people's retirement money. Our alternative is to not have those drawdowns in the first place. And a drawdown is just the move from, the highest you had in terms of assets down to the bottom before it starts to recover. If you can avoid deep drawdowns, then you don't have to worry about making sure that you're there for the rebound. You don't have to worry about making a bad decision at the bottom. It goes right back to that prop desk mentality at Scotia. The best way for us to survive was not to lose money. And that is very, very true for us at EHP. And we think ultimately that's what our clients expect from us. Don't lose my money. I've worked hard to earn it. I don't need to knock the lights out. I don't have to own Tesla for a 10,000% increase. I just need to make sure I get a reasonable return on my money, but most importantly, don't lose it. So that really, for us, that process helps immensely when managing the stress of what is a complex job.
Well, great. Well, thank you very much for your time today, Jason. Appreciate the insights. Appreciate the way that you guys look at things. Obviously, been very successful, and we wish you all the continued success. And if you do want to know more about about EHP or other types of funds or some of the strategies Jason mentioned here today, please do reach out to us at Staratt Wealth Management. More than happy to chat with you or anybody that you know about the strategies and about our methodology to determining good managers like Jason. Thanks again.
Thanks, Scott.